Hi everyone. People are starting to roll in, but I'll get things moving. My name's Mark Masson, by the way. I'm a director with FD Recruit, and we are leaders, if not the leading finance director and CFO recruitment group in the UK. Today's event is about building business value, and Andrew Thomson, who has very kindly agreed to lead this. Andrew is a founding partner of HMT, a leading mid-market corporate finance boutique with offices in London and Henley. And Andrew's going to cover a range of subjects. And please put any questions in the chat box, and Andrew is going to filter through them, answer as many as he can in about sort of 20 or 30 minutes or so before we close off. So, Andrew, would you like to kick off with your presentation? And again, thank you very much.
Yeah, thanks for the introduction, Mark. Hello, my name's Andrew Thomson from HMT, as Mark said. The subject of the webinar is building business value, which from my point of view is just about optimising the sales price from the seller's perspective. 30 minutes can't really do the subject justice, so I'm just going to really quickly walk through the principles and just flag a few issues that come up in my experience. Therefore, please reach out if I don't cover anything you do want to cover in the next 30 minutes. Given the audience I'm speaking to, I suspect understanding the value equation is probably just a recap for you. So I'm going to talk through that, and then the three constituent parts, which are about EBITDA. We can talk about how that could be optimized, the EBITDA multiple and how we could influence that, and then look at the debt and cash free adjustment. And then I'll finish with some concluding thoughts. So the value equation, it's not always relevant valuation methodology, and I'll give some examples later why, but it is the default method. And essentially we are taking profit, times it by a multiple to give enterprise value, adding free cash, taking off debt to come at the equity value, which is the return to the shareholders. In terms of profit, sustainable EBITDA is normally the proxy, is normally what's used. That is a proxy for cash generation. And the multiple, and at a very high level, the multiple is just really influenced by two factors, and that's the risk profile of the future revenue and its growth rate. And that should be referenceable to comparable transactions. When wouldn't you apply a value equation? I say it's normally always used when it's a profitable trading business, but if there's no profit, and that can be businesses with lots of inherent value, such as early stage, high growth businesses, where you'd value on a DCF basis, or they could be struggling businesses, you may value on a breakup basis, and things in between. Another example where it may not be relevant is where you've got asset-rich, capital-intensive businesses, such as a rental business with a fleet which could be asset-funded. So the first constituent is sustainable EBITDA or marketing EBITDA. A buyer would typically want to bid for a business off the historic EBITDA. That could be last year's reported numbers. It could be the average of the last three. And what you want to do is point the buyer to the largest number, which, assuming it's a growing business, it's going to be by moving them from the left-hand column to the right-hand column on the table above. I mean, just looking at the steps to get there. If you want to capture the growth since the year end, you should be looking at the last 12 months EBITDA. A critical point to that is whether you do have robust monthly reporting to allow you to do that. We sometimes see there's an issue where, for example, WIP stock or long-term contracts aren't valued on a monthly basis. Moving to the next step, if you can, if you have recurring revenues, you might be able to point to some sort of run rate analysis. To achieve that, you really need to evidence contracted recurring revenues with low attrition. Obviously, very suitable for a SaaS business. If you're project based, that's less obvious. And sometimes a business may have both those elements in its revenue line, in which case your run rate analysis may value the project-based work looking back 12 months, and the SaaS revenue could be on a run rate basis. The next step up is to look at normalized adjustments, and that could be around accounting policies. I mean, normal areas where you may look at that could be around revenue recognition and capitalization, and then you could look at non-recurring or normalized costs. These could be excess vendor costs in the business, for example, or other non-recurring costs in the business. If you can evidence growth through extrapolating historic trading, have a robust pipeline, and if management have a track record of hitting budget, then you may be able to justify an outturn valuation. Important point to make is one good year doesn't tick the sustainability box, but I'll say it's moving the buyer from the left-hand column to the right. So the second constituent, the multiple, and I say that is a factor of simply risk and growth rates. There are, as I said before, one good year doesn't tick the sustainability box, and if you have clear positive historic patterns of growth, that allows the buyer to extrapolate to get some comfort in your forecast numbers. That's obviously much more attractive than when you've got erratic trading with a lack of clear sustainable trends. And that may time when you take the business to market, you may want 2 or 3 years of that historic pattern. It may be a case of looking at accounting policies and see whether you can change your policy to smooth out some of the peaks and troughs. The scale of the addressable market is obviously really important as well. And it's important when you do articulate your acquisition proposition, you understand your market. And that's got to be the size and what the key drivers are of that market, including regulatory. It's important to be able to identify and articulate any untapped inorganic, organic opportunities. And you need to demonstrate you understand your competitors and you can articulate your USP. And that could be, that's your secret sauce, that's your competitive advantage. It could be around unique technology, know-how, or market-leading business practices. Scalability operations is also important. And obviously there are challenges there for capital and people-intensive businesses versus those that are tech-enabled. In terms of sales visibility, as I said before, it's about evidence contracted, recurring, repeat revenues, and your order book pipeline. It's important to build your story around customer stickiness and sales and margin data on a customer-by-customer basis. If it gives the right answers, it's something you should be presenting. In terms of value depressors, you should be considering what the dependencies are in your business and build a story to mitigate against those. And that could be around regulatory, management, customer concentration, and key suppliers are typical examples. And it's important as part of that you do build your management succession story, and it's quite clear if the shareholders or the founders are going to be leaving the business, who's going to be running it going forward. In terms of scale, size will positively impact EBITDA, i.e. the larger you are, the larger multiple you will achieve. And that's why the buying and that EBITDA arbitrage is what really drives the buy and builds, which is probably the most active acquisition category at the moment. Market sentiments, and that's really evidenced by present transactions. And looking at some of the above examples, different sectors will have different attributes, and that does determine the multiple. And everyone will have access to the same data. So when you do come to think about valuing your business and put it for sale, you do need to reference it back to those present transactions. What I would say though is published data does overstate the true multiples. That's because the EBITDA is quoted on historic EBITDA. They don't normalize adjustments, and they typically assume an earnout's been paid in full. In terms of debt and cash flow adjustments, the third element, that's typically determined through the lockbox or a completion account mechanism. As a seller, you want to err towards a lockbox. It is seller friendly. and it does give certainty on valuation pre-completion. When cash is measured at the completion lockbox date, you normally normalise it by looking back 12 months. So if you want to get the full benefit of that, you need to start optimising working capital then. And as an arithmetic example, if you maximise cash only at the lockbox date by stretching creditors, reducing stock and that, you will actually only benefit, the seller will only benefit by 1/12 for that. The debt definition can be incredibly subjective area. And I'll give some examples there of examples that you normally have a discussion over. Probably the biggest one is deferred income. And the question there is deferred income part of the working capital of the business, or is it a debt item that comes off the price? A principle I always work with that as a seller, you're in a much stronger position pre-completion. So if you're going to have any key arguments, have them right up front. When I'm selling a business, I will actually typically send out a lockbox calculation of the free cash and get that agreed as part of the heads. Why do I do that? I mean, the cash and debt-free adjustment can impact value significantly, even if you don't think you've got debt items on the balance sheet. And similarly, you could have significant cash that get absorbed by debt items or working capital adjustments. In terms of some concluding thoughts before we go into the questions, that it's never too early to start preparing. You've got to make sure your whole team, your advisors are aligned around the story you're selling, and that's about amplifying the positives and build a case up front for mitigating the negatives. You must make sure your due diligence ready, and you should be, prior to that process, collating the evidence to support your acquisition proposition and make it easy for them to get to your number. You need to think about the EBITDA that you're going to be selling the business off, and you should time your sales process accordingly. If you've had an erratic few years and next year's going to be a good year, it might be too early to go to market. In terms of the normalised adjustments, I would say push them, but don't push them too hard. And you've got to be able to robustly defend any of those. Working capital, if you don't understand and optimise it, you will leave value on the table for the buyer. Your forecast, you really have to strike the right balance. They've got to be positive, but they've got to be achievable. And then finally, a well-run competitive auction should drive additional value. Thank you.
Well, thanks very much, Andrew. That was great. From where I'm sitting, anyway, really comprehensive. It might be that actually, does anyone? I mean, I've got a few questions, but first and foremost, from the audience, I don't know if you want to either put them in the chat box or stick your hand up if you'd like to, and just take yourself off mute and fire away and ask Andrew the question. So I don't. Has anyone got a question that they would like to ask? If not, I don't know if anyone was going to say something there.
I've got a question.
Yeah, please go ahead.
Just for a new business, either a new business or a takeover of an established business, which is obviously different to the business historically. If you've had a good year, let's say you've made £1 million EBITDA, and then a bad year, you've lost the £1 million EBITDA, how would you then look at valuing a business? Because you could obviously put a positive spin on it and say, oh yeah, it was just a blip. So
again, you've just acquired a business. Is that what you're saying, Stephen?
Yeah, so I'm talking about either a new business or a newly acquired business that's been taken over by new ownership.
Yeah.
They've sort of turned it around and had a good year in the sort of first year of full ownership. Second year of full ownership, had a bad year. Then go and try and sell the business. What's the business worth? Because on the one hand, you could say, well, we've turned it around and had a really good year, but then they've had a bad year. So it's kind of like you can't look historically because it was a different business.
Yeah,
One good year, one bad year.
Yeah, at the end of the day, you're actually selling on future revenue, and actually what you've historically earned is just a proxy for that. And it's about demonstrating what is a sustainable level of EBITDA. Was it the million, or is it the break even? I mean, a good example is you had lots of businesses some businesses struggled in COVID, others had a massive bounce back. We had a client that was making masks. They obviously had a fabulous year, and it's fallen off the cliff. What they made historically just wasn't relevant to the value. So what is the plan? Where's the business going? And in terms of those key elements of the plan, can you demonstrate those to reference how the business is trading at how it traded historically? And I guess the challenge is, if there is value there, why is it only breaking even now or losing money? And what is the management plan to get it to the next level?
It was more about the future rather than the past, and selling the story.
It's people bid off EBITDA, but it is about a proxy for what the future profitability is going to be. The fact it was in different hands, I wouldn't say that wouldn't be relevant to demonstrate the underlying value of the business.
Mm-hmm. Okay.
And quite often, if we're selling a business made 2 or 3 acquisitions, we will pro forma in the profitability of those acquisitions going back 2 or 3 years, just to demonstrate what the combined group would have looked like if it had been in situ for that 3-year period.
Mm-hmm. And another quick question, if you don't mind, it might have been on the early slides, but I was late joining. I had some technical problems. Just in relation to the sort of relationship from balance sheet to P&L. So let's say you've got a business that's profitable, but if you look at the balance sheet, there's no cash in the bank. It's got either negative or zero sort of in terms of net assets. What is it? Is it a balance of the balance sheet position and the EBITDA, or is it?
No, well, it's EBITDA adjusted for any free cash in the business. So let's say you had a business making £1 million a year, and we thought it was worth 6 times that. That's a 6 million enterprise value. If there was 2 million of debt in the business, the equity value would be 4 million.
Right. Okay.
Thanks very much, Stephen, for that. And Andrew, there's a question in the chat box from Lack. I don't know if you can see that.
I can't see the chat box, no.
Oh, okay. So I'll read out the question. So Lack has asked, how often do you see consideration based on GP rather than EBITDA multiple?
A good question. I mean, the GP will drive the multiple. A business with, and it is about the quality of revenue, a business with a low margin will typically attract a lower EBITDA multiple than higher margin. Typically, where it's on GP, it's where you typically do that would be where you're looking at integrating the business. So you might be acquiring a business that's not profitable with a decent gross profit, but all the overheads are going to disappear when you integrate it with your own. So we certainly, I do see it, not that regularly. It tends to be on a specific case, and it's where there is going to be an integration of the businesses, and those overheads will disappear.
Thanks for that question, Lack. David has asked a question which I'll read out, Andrew, for you. Yep. So looking at deferred income, if a business has a regular annual support revenue, which is highly repeatable, why should the deferred income balance reduce the value? Thus, this just funds the acquirer if deducted.
Yeah, good question. Look, I'm half the time I'm a buyer, half the time I'm a seller. I will change arguments. If I'm buying a business, deferred income isn't my cash. It may unwind. That comes off the price. If I'm selling a business, I will argue that actually it is part of the working capital constituent. It doesn't unwind, and you shouldn't take account of it. So it's as I say, it's probably the biggest argument you ever have on a transaction. We're doing one at the moment where we're selling a business that's it's in the hospitality sector, has lots of deferred income, and what we agreed there was that we'd take off the gross margin on the deferred income, and we'd net the deferred income with any advance payments on those contracts. But it is quite often, I've done 2 or 3 transactions the last 12 months where we did a 50-50 split. It's something where you argue your case. And again, if you're selling a business, I would always try and get that clarified at the heads of agreement stage for exactly that reason. There isn't a right or wrong answer to deferred income.
Can I just ask a question there, Andrew?
Yeah, sure.
Yeah, I mean, you're saying it doesn't come off. So deferred revenue, in essence, is it's a pre-bill, isn't it? So, if you're a marketing agency, you might have a situation where there's a campaign, hasn't been started.
Yeah.
The client has asked for the pre-bill to protect their budget.
Yeah.
And say the pre-bill, for the sake of argument, say is £100,000. So you've cut the invoice for £100,000 because the client wants to protect their budget. But if you're selling the business, you've cut the invoice, you've had the money.
Yeah.
The work hasn't been started. So I hear what you're saying from the seller's viewpoint. You don't want to make the adjustment, but the buyer's going to argue, well, you've had the money, the work hasn't been done. It's going to come off.
Yeah, but the question is whether deferred income is a working capital item or it's a cash item. I mean, creditors, you could argue the same. You've incurred that cost, you've not paid the creditors. So that's why you look at normalising the working capital over that 12-month period to understand what the requirement is in the business.
Okay. All right.
It's around lockbox. It's the biggest discussion point, deferred income.
Okay.
Oh, and thanks. David's asked a question. How would valuation of capital oblique asset heavy businesses, for instance, property based businesses, differ?
Yeah, because obviously, I mean, what's a typical yield on a property business? Maybe 6%. So that's an implied multiple of kind of amounts about 15 times. And so actually, if you valued a business with a yield of 6%, you may find with a 50% mortgage, the assets underwater. I guess, example, if I was selling a business with a property, for example, I would do a sum of parts valuation. I would value the property standalone. I'd then work out a notional rent for that property. I'd deduct the rent from the EBITDA. So I'd value the business without the property, and I'd value the property separately. If you are, for example, a property letting business with a big property portfolio, the first thing is you've got to look at the alternative use and market value for those properties. And I've had cases where I've looked at businesses where there was more value in the property than the trading business. And the question is, do we close the business and sell the assets? So property is typically done on a yield. If it's a property letting business, you may look at it at a PBT level, profit before tax. So you take your interest costs off because it's highly geared and look at a multiple of that.
Thanks very much. A question from Vijayaram. Are you seeing any trend in valuation shifting from leaning more towards intangible rather than tangible assets?
Well, if you think about the valuation we talked about, actually, that whether it's a tangible or intangible asset doesn't actually won't affect that methodology. I mean, where the intangible asset will drive the multiple. If you have got technology, if you are tech enabled, yes, that would drive valuations. I'm not seeing a shifting trend. I do a lot of private equity work, and those guys for that last 10 years have been investing in tech enabled high growth businesses. Those are the ones that were COVID resilient, of course. A lot of B2B businesses rather than B2C, but we wouldn't necessarily be valuing the tangibles, intangibles on the balance sheet. It's about results and profit.
Sorry, what was that? Okay. Another question. Oh, I think it's a follow-on question from Vijaram. This is more related to investments in ESG, digitalization, and erosion of value in commercial properties, etc.
Right. I mean, it's a very hot topic.
Yeah.
People would be investing in that. It's I guess, yeah, the valuation of the intangible is going to be a function of the profit it's going to be throwing off. If you're if you're early stage, high growth intangible business, maybe growing sales by a double-digit multiple every month, then you're going to be valuing that on a discounted cash flow basis. So implied with that will be significant value for the intangibles.
Okay, thanks for that. I don't know if we've got any more questions. I might pop one in myself as we draw things to a close, but certainly any more, stick them in the chat box before we close up. But Andrew, what's, I mean, you know, a pretty broad general question here, but how do you see the outlook for the the last 6 months of this year and next year? What are your thoughts?
It's really difficult to judge. There's obviously, there's a lot of uncertainty around the corner. Consumer spending must start to be hit with interest rate rise. We are as busy as ever. We're seeing lots of transaction. I think from a transaction point of view, I think because this uncertainty, they're taking longer and longer to do. If you're buying a business, just slow the process down, have another 2 or 3 months to keep an eye on trading, make sure it can be robust and deal with some of the shocks that may be to come. I find it really difficult to judge. We're working on the basis it's business as normal. I think we'll probably see a shift in sector. I think business to consumer have been tough the last year or two. I think that may get tougher. The B2B, where we sort of focus most of our work, it does seem to be it seems to be going strong, and I think a lot of that's down. There is a lot of liquidity around there, around the institutions, be it the banks, the private equity.
Oh, yeah. Thanks, Andrew, for that. And what would you say are the most sort of 2 or 3 sort of challenging type of situations in your work and the deals you're involved with?
What, in terms of a transaction at all, or types of transactions?
I would say either, let's say types of transaction.
Are the most challenging in terms of transaction. Yeah, I would not be wanting to be selling well, if we look to the valuation, I guess so when you go back to valuation also, I think there is another point, is actually some businesses just don't have any value at all. They may not have enough scale in terms of profitability. They just may not be viable. And I think my biggest challenge is being introduced to maybe a distress situation, so something needs to happen, and there just isn't a solution for that business. They're few and far between, but a sort of loss-making with a balance sheet that's been destroyed over the last 3 or 4 years, and no sign of recovery. Sometimes there just isn't a solution. But probably as an advisor, where I'm buying businesses, probably my biggest challenge is where the seller isn't advised, and they just haven't got a view on it. They haven't got reasonable price expectation. You've got maybe management want to do a buyout. You've got a willing buyer, willing seller, and the other side just hasn't got a realistic view on his valuation. Yeah.
Well, thanks for that, Andrew. I think that's it. We don't have any more questions as yet, but so I'll close off. Is there anything in particular you want to say, Andrew, before I close off?
I just said I thought there was only a few questions. I wouldn't have talked so quickly. But if anyone does want to reach out to me, I think you've got my contact details. More than happy to pick up on some of the issues we discussed there, or any questions on specific situations.
Yeah, well, no, that's okay. We're not far off the sort of time we prescribed as it happens. But But no, thanks very much. As Andrew said, do connect with Andrew or get in touch with him on any aspect of your business, etc. Also myself, Mark Masson, connect with me on LinkedIn if you wish. But closing off, thanks very much, Andrew, and everyone who joined us today. Just a few things to mention before we go. Christiane, I don't know when the next event is, but they're all on our website.
We've got one next Thursday, actually. On
okay.
I'll just
okay.
yeah.
But they're all on the website. We're going to send out a short survey following today's event. Be very grateful if you could fill it in. It's pretty short, just to help us improve events, really. You can also collaborate with other finance directors, CFOs, etc., on our FD and CFO network Guild app, which is a messaging platform. But we'll send out details of that in an email if you don't know about it. And just briefly, we are first and foremost a recruitment, an executive recruitment search organization. And we run these events as a way of giving back, if you will. So certainly don't sort of ask for anything in return. But if you've got any, with my recruitment hat on, I'm sure you won't mind. If you've got any vacancies that you're able to direct our way, we'd be extremely grateful. As the Exec Recruit Group, we've got divisions in accountancy recruitment, finance director and CFO recruitment, as you know, but also HR recruitment and general management and C-suite executive recruitment across operations, marketing, tech, and board. So thanks very much. That's the recruitment pitch side of it, and links to the divisions are all on our email. So thank you very much, and hope to see you again. See you again soon.